You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
So in 2023, after a very slow stainless growth year, this year we're expecting to see a pretty strong rebound next year. But we really are seeing huge amounts of supply coming on stream in the form of MPI, the nickel hydroxide intermediates from the HPAL plants, and in the form of laterite matte from the conversion of MPI as well. And so we expect to see the market in a surplus in 2023 and for the subsequent years of about 100,000 tons, which is not a small amount, but then it is, we're talking about the market, is getting towards, is over 3 million tons a year now. So as a proportion of the overall market, it's not a massive surplus. And it's worth noting that I think we expect most of this surplus to be on the Class 2 side of the market.
Hi, guys. This is Brian Leni of Mining Stock Education and JuniorStockEducation.com. Today with me, I have Martin Turenne, CEO of FPX Nickel, and Alex Laugharne of CRU. Hi, guys.
Hey, Brian.
Brian, good to see you.
Great to have you. Last year we did a nickel panel. Nickel's been hot for a number of years. This year is quite interesting, and still I think there's still bullish sentiment in the air, but it's definitely a different market. I wanted to start off with Indonesia. I think Indonesia is maybe the hottest topic in the market from the research that I've done anyways. And so for those that don't know, Indonesia's influence over the global nickel market has grown significantly over the last 5 years. It started with export bans, companies such as Sinshon to build, infrastructure within the country. And then we have the MPI to nickel matte conversion, which started to feed the market late last year, early this year, I guess. Alex, starting with you, can you give us an overview of the current and future role of Indonesia in the global nickel market?
Yeah, absolutely. I mean, it's by far the most important contributor to new supply over the next 5 or so years, with three key main sort of supply routes, if you like. Firstly is the production of NPI, which we've been seeing growing, for several years now, ever since the ore ban was instituted. We expect to see more and more NPI coming out, although the volumes, I think forecast for sort of 24, 25, 26 around there are slowing down a little bit compared to the hundreds of thousands of tons we've seen coming on each year for the last several years. The other key route is on the hydrometallurgical processing of the ore. Rather than smelting it to produce NPI, you hydrometallurgically process it and you end up with an intermediate called MHP, mixed hydroxide precipitate, which contains both nickel and cobalt, and can be quite readily converted into nickel sulfate for use in batteries. So it's a very important route to get nickel into a sort of the correct form for being processed into sulfate for use in batteries. We're seeing a very substantial. There's 3 or 4. The first of these projects, Obi Island, owned by PT Ligend, began operating last year, and unlike some hydrometallurgical projects in the past, is proving relatively successful with its ramp up. And we anticipate several more of these kinds of projects coming on stream over the next several years with a combined capacity of more than 500,000 tons of contained nickel. So a very important additional supply route that's again almost entirely based within Indonesia. The final route is somewhere between the two, if you like. It's essentially the conversion of the iron nickel alloy that you would get from the smelting of laterite ore, where initially you would cast it to produce NPI, but instead you convert that to sort of a laterite matte. This is the kind of process that PT Vale Indonesia has been using for a long period of time. But then, whereas they have historically converted that matte into a higher grade metallic product, which is still used in stainless and other alloy steels, you can instead convert that laterite matte through to nickel sulfate for use in batteries. This is a pretty, it's a more involved process, right? You need the additional capital expense of the converter facility. It comes with higher carbon footprint because the initial production of NPI is relatively carbon intensive, especially in Indonesia, where the power base is mostly coal. But provided the spread between the NPI price and the sulfate price is large enough, then you can do this economically. And we've seen over the past 6 months or so that the NPI market has been discounted against LME metal, and those discounts have grown significantly over the past 6 months to a year.
Okay. Martin, do you have any comments on it? On Indonesia?
Yeah, no, it's true that Indonesia is really, it is the Saudi Arabia of the nickel market. All of the growth has come there in the last several years, and as Alex said, I think over the next 5 years, largely the growth will continue to come from that country. I think the questions there, and Alex alluded to it, are a little bit about the carbon intensity of production, as well as the, who really gets these nickel units. These nickel units are almost exclusively, when it comes to Indonesia, being controlled by Chinese interests. There is Vale is making moves to expand some of their footprint of production there. So the question really becomes, if China is being served ultimately by these units from Indonesia, where does the rest of the world get its nickel units from?
Okay. So, in terms of supply right now, the Chinese are the main consumer, though, of Indonesian nickel, besides, the battery grade stuff and the laterite matte. Is that correct?
Yeah, of all forms of class 2 nickel for stainless and class 1 for batteries.
So, what would you say on a percentage basis? How much of the world, or how much of the Indonesian nickel products make it to the rest of the world right now as it is?
Good question. The substantial minority, really, especially, and most of the new supply, exactly as Martin says, is being developed with Chinese investors, Chinese backers, big consumers, people like GEM and Huayu Cobalt, who are important players in the downstream nickel production of nickel sulfate and precursors for batteries. So, of the new supply, nearly all of it, outside of if Vale are expanding their operation, they push ahead with Pomalar. And the BASF and Eramet joint venture, both of which are pretty early stage, 4 or 5, maybe more years away from production. All of those new projects are Chinese backed. The PT Vale existing operation, I think a lot of that ends up in China, but that's 30,000 tons compared to these new projects. So, there's 4 or 5 of them just on the HPAL side, the hydromet projects, and they're each going to do, 60 to 100,000 tons. So the scale that is not going to China is very, very small.
Yeah, because I wondered, because, the environmental point is a big one, and it's the one that pops out first, I think, as the concern with Indonesian ore. But China has shown that they don't really care about the carbon footprint. They'll take security supply, I would say, is a bigger part of the equation for them, rather than, the carbon footprint, especially if, what the Indonesian government has done is they said, okay, look, we're going to ban exports and force you to do secondary refinement within country. So that might even be even better for the Chinese, saying, hey, keep the pollution in your country and we'll just take the end product, that security supply. So all I'm saying is maybe it isn't as big of a point as maybe it seems, just because the Chinese don't seemingly buy into the whole carbon footprint. But that's just a comment. Alex, you mentioned before about HPAL, and for the viewers, HPAL's got a really sketchy past. The Sherritt was almost destroyed by their debacle in Madagascar. Major capex overruns. I still don't. Is it in Bobidiv? I forget how you say where their HPAL plant is, but capex overruns. The production's still not where it should be. So is HPAL, are they finding a way to make HPAL work? Is that technology reaching a point where it is a viable, maybe negative towards a bullish nickel future, do you think?
I think it's certainly, so far it seems that way. I mean, the capital costs have been substantially lower, I think, through 2 main reasons. Firstly, using Chinese EPCM companies, and one in particular, which has proven successful in developing these projects thus far. I think they worked on the Ramu project historically as well, which was one of the most successful hydro projects historically in Papua New Guinea. And secondly, the use of capital costs have also been pushed down by the use of sort of these infrastructure parks, the Morowali Infrastructure Park and the one at Obi Island, which put a lot of facilities on site and helped to, the port is built. So the massive amounts of infrastructure that are required, for example, at Mbatavi in Madagascar, are minimized. So I think that really helps on the capital cost side. And it seems to have been borne out that, the capex for these projects, maybe not quite as low as initially scheduled, but still much, much lower than the eventual numbers for some of the historic HPAL plants. But the ramp up seems to have been relatively successful as well. I think maybe it's just a question of lessons learned from historic projects. Maybe it's a little bit easy. I think one of the key issues with HPAL projects in the past is variance in the ore grade. I think the process can be very, very specific to the nature of the ore. And I think historic projects, as they've worked through the deposit, the content of impurities or the nickel content has changed a little bit. And then it's really hard to recalibrate the process if you suddenly need, twice as much sulfuric acid for leaching as you did previously. And the scale of the project doesn't match that. You need to resize everything. They, as yet, and I mean, we're only really 1 year into operation for the first project, have not really been running into those kinds of issues so much. That said, there are other challenges that potentially limit the future scale up. There's a lot of good ore in Indonesia, but it isn't an infinite resource. Like I say, the carbon footprint is a factor, and I know that Tsingshan is apparently thinking about, or there's rumors that they're looking at building hydroelectric dams in order to decarbonize the NPI production, for example, which would take down the carbon footprint of that NPI laterite matte a chunk. But the tailings is a huge issue. They didn't get permission to use deep sea tailings, which was the initial plan for some of these hydro plants. So they're using onshore tailings. And, Indonesia is a very high rainfall, very high earthquake risk location. So there's clear concerns on that front.
Okay. Well, those are really good points. Martin, do you have any comments on the HPAL?
Yeah, I think Alex raises a great point just around the sort of the feed control, right? You're dealing with run of mine ore, and as these deposits move into different phases, that'll be the key question, I think, for people to see whether they can maintain sort of consistent production given, the fact that deposits are inherently variable by their very nature. And, but that can be controlled to a certain extent if you have kind of good processes in place to really be sampling that before it's being fed into the autoclaves. So I think building, large stockpiles and having very precise sort of feed control, processes in place is something that could potentially mitigate against that risk and allow those projects to kind of not just reach nameplate, but deliver at nameplate on a consistent basis where the past projects really never were able to.
And those stockpiles of ore have been developed because when you're digging up laterite ores, it's the deeper saprolite ore is what's used, which is higher grade, and that's what's used to produce NPI and ferronickel. And the limonite ore that sits above that because it's unsuitable for really turning into NPI or a good portion of it, but it is very suitable for the hydrometallurgical process. So there have been these large stockpiles that have been built up in Indonesia as the saprolite has been used to produce NPI. There's stockpiles of this limonite, and exactly as Martin says, it's easier to secure a consistent feed when you've got a large volume of sort of stockpiles sitting there waiting to be used.
Makes a lot of sense. So kind of continuing with like that carbon footprint mantra, the EU kind of has led the way. I forget when it exactly happened, but it's at least a couple of years ago, maybe prior to COVID. They came out with basically traceability, or they connected the carbon footprint to the use of battery metals within that manufacturing chain within the EU. I'm not aware, at least, of any other countries kind of following suit. So my question is more broad-based, do you think that's to come? The EU has led the way. Are we going to see that in North America? Are we going to see that maybe South America or any other countries around the world? Alex, if you want to start.
I'm not aware of anything too specific like that. I wouldn't say it's something I'm keeping an incredibly close eye on myself, so that there definitely might be things out there. But from a North American, from the US perspective, I don't see any sort of carbon border adjustments being taken into account. I think outside of somewhere like the EU, it's more likely to be driven by company policies rather than governmental ones, or at least maybe Canada's a different question. You guys might know better than me on that. But yeah, within the US, I don't see any movement in that direction. Okay. Martin?
Yeah, I think Brian, you're referring to something that was published by the European Commission called the Sustainable Batteries Regulation, which I think it did come out about 18 to 24 months ago in sort of draft form. And basically what it said was that they were going to require battery makers and car makers to have certifications of carbon footprints on all products to be sold within the EU market. And that they would in years to come be establishing a threshold or a cap, basically, and that above that cap of carbon emissions, that those products wouldn't be able to be sold in the EU. I don't think that those caps have been defined. To your question there, Brian, I think I don't see anything in the short term in terms of the rest of the world adopting similar regulations, but I think the winds are blowing in that direction more generally, for sure, from a longer term standpoint.
So again, to both of you, would you say security of supply then is definitely the number one driver of nickel demand, like at least in the short term?
For sure, I'd say so. I think unfortunately people in the nickel market don't at this point have the luxury of being able to exclusively know that they're going to secure green or lower carbon or extra sustainable sources of nickel. At the moment, it's just getting hold of enough material first and foremost, preferentially and ideally from lower carbon and close to region or free trade agreement countries, not China, not Russia. Certainly those are strong preferences on behalf of the consumers, but it's secondary to just getting hold of enough material altogether at this point.
Yeah, totally agree. There is a scramble on for nickel units, and if there's a hierarchy of needs, so to speak, it is just getting the units. Cost and traceability and carbon footprint are important considerations, but they're secondary to just getting the units.
I think, and on that, one really interesting trend I think we're seeing more and more of is really over the last year or 2 years, the OEMs, the downstream cell manufacturers and the EV makers get much more serious about investing or acting to secure material much further upstream, moving back towards mining and initial processing, not obviously operating those sorts of things, but having maybe an equity stake or talking to the people who are producing the intermediates, which may be 2 or 3 or 4 or 5 steps away from going into an EV. So what we're likely to see is sort of this transition where we need much more of a custom refining sector that will all operate on a tolling basis, because your EV manufacturer will be securing material in MHP form, and they'll need to then pay a refiner to turn that into nickel sulfate, a precursor manufacturer to turn it into PCAM. Maybe that will be the same company because there's quite a lot of integration between the nickel sulfate and the PCAM. Then someone else to turn it into the cathode active material, and then someone to into the cell, and then it can go in the battery, right? Into the EV. And there's not a huge amount of that sort of custom refining at the moment, but it's much less of a concern, right? There's not really the same fundamental bottleneck that is linked to the material in the ground, or the challenge of that first processing step. Those sorts of refineries are short lead time, lower investment. It needs to occur. And I think that's where we may see more of that final step refining taking place in somewhere like Canada, where we're seeing more and more of the establishment of battery material parks. There's a lot of investment going in Bécancour in particular, where people are looking to establish that sort of final step refining, which may be associated with some of the upstream, the nickel processing, which obviously, you have up in Ontario and Quebec, and potential lithium production taking place there as well. But doesn't necessarily have to. You can be bringing in intermediates from further afield, doing the final step refining closer to where the material is going to be used.
That's a great point. So do you think, is it a point or an adoption percentage that we need to see in terms of EV adoption to really spur that? There's bits and pieces, Tesla, Elon's been, fairly vocal about, lithium and talking about nickel. A couple of the other European battery manufacturers, if I recall correctly, have touched on exactly what you just said. But for it to happen en masse, do you think there's a particular demand number we need, or an adoption number that we need to see for a lot of these companies to really come into the market and say, hey, look, we're going to start buying up these projects, or not buying up, but taking large parts in these projects? Do you think that there's a percentage there that we're looking for?
For me, it's not consumer led in that way. It's much more if Ford or GM want to make however many millions of EVs it is, and they're going to invest in huge amounts of lithium ion battery capacity as well. If they're going to be, operating that level of capacity, they need those raw materials. And And I see it much more working that way on, right? If we want to build that much cell capacity, we're going to need this much nickel and lithium and various other materials. And therefore we need to, right. And that is one of the biggest risks to making those operations run successfully is securing enough raw materials and ideally at a reasonable price.
Okay. Hey, Martin, do you have any comments on that?
Yeah, I do. I mean, we've been spending a lot of time talking to the chemical companies, the battery companies, and the OEMs, and getting an understanding of where their thinking is at. And they're certainly coming up a fairly steep learning curve, I think, here over the last couple of years as to how they're going to solve for their procurement challenges. I think at the outset they might have hoped that the mining industry would just kind of produce these raw materials and sort of solve for that. As by the benevolence of the actors in the mining industry. And I don't think that's really going to happen without significant upstream investment by, the downstream consumers. And in some ways, the groups that are the most sort of pinched by this really are the OEMs themselves. They are having to now deal with these government regulations around, a certain percentage of EVs being sold by a certain date, either 2030 or 2035. Half of their cars are going to have to be EVs, as mandated by various governments globally. And so they're now under the gun. And when it comes to sort of deployment of capital to build out, new mines and the new sort of refining and PCAM and CAM production facilities, there's a bit of a staring contest. I think that's kind of been going on, will continue to go on to a certain extent, between all the parties in the supply chain as to who blinks first and who's forced to deploy capital first to ensure that the supply chain gets built out. And in my view, the OEMs will be the ones to blink first, and because of the pressure that governments are putting on them, and we will continue to see considerable upstream investment by the OEMs throughout the supply chain.
Very good. Much of the talk and, the first thing I've been thinking of when I was putting together the questions for this interview was centered around batteries, and I think that's probably where everybody's mind is. But still, nickel is very much a stainless steel driven market, at least in my view. And so, Alex, could you take us through what does the stainless steel sector look like right now? Is the demand still there for stainless?
We're actually seeing quite a big slowdown in stainless growth this year in 2022 after having had a huge 2021 and then a bounce back in 2023. So yeah, in this year in particular, we are seeing stainless demand come down in quite a lot of different regions due to a variety of different recessionary and other factors, but still see it growing at, let's see, around... Yeah, pretty substantially in 2023, maybe 10% growth in 2023, and then maybe more like 3 or 4% growth in the years following that. Obviously, the rate of growth in battery side is much higher than that.
Is the stainless market still primarily like a sort of like the battery market? Is it primarily driven by Asia? China being the big driver? Yeah. Okay.
Yeah. I mean, there's still more so than carbon steel, for example, where carbon steel is a little bit more exposed to developing economies. Stainless steel, because of the good use in consumer durables, in industrial applications, and other more varied end uses, it does have a bit more of a skew towards more mature economies as well. So the US and Europe are still really important stainless consumers as well. But China and Asia are the largest and most important.
Inflation has gripped the world over the last couple of years, so much so that it's become a political topic. This summer in the U.S., we saw the U.S. government institute the Inflation Reductions Act of 2022, which oddly in my mind, focuses some spending on renewable energies sources and tax credits towards EVs. In the past, we've seen incentives work. I think China was probably the best example, at least the data that I saw. The incentives really drove EVs, and as soon as the incentives were taken away, it really dropped. So Martin, in your view, are the incentives enough to push the market into a higher adoption of EVs, or does the market require something more to happen?
Yeah, it's an interesting question. I mean, at the end of the day, I think it comes to what is the cost of ownership of an internal combustion engine vehicle versus an EV, and the subsidies obviously serve to, shorten the gap, let's say, between the sticker price of one versus the other. Whether that's enough, whether the federal EV subsidy in the United States, which is $7,500. Whether that's enough to kind of spur that uptake, that I suppose that remains to be seen. It's also interesting, I think, how that subsidy is sort of organized and what's viewed as being eligible. Alex may have a better view on when sort of these vehicles start to reach sort of price parity, let's say, on a total cost of ownership or even on a sticker price basis. But I still think that that's several years away, even with these subsidies in place.
Yes. Well, I think on an unsubsidized basis, we would see it getting there in many regions by these calculations have been thrown out a bit. Lithium at $70,000 a ton really adversely impacts the equation, with nickel prices being high as well. But lithium really has thrown it out of whack and prevented battery prices to continue to decline as they have done over the past 5 or 6 years. That said, I mean, at least at CRU, we see lithium prices coming back down from sort of 2024 onwards, which will help to normalize things. And yes, maybe in the later 2020s, we'll see EVs, full battery electric vehicles, be sort of better on a total cost of ownership basis, even without subsidies by that point. But before that point, we're definitely still dependent on subsidies in order to put the thumb on the scale or make that equation work, if you like. That said, I think the key short-term bottleneck is still EV availability. Most of the producers are sold out. Any new EV that comes out has a very long waiting list. And that's without necessarily those subsidies being guaranteed. And indeed, all eyes are on the IRS for they're due to provide a greater elaboration on the specifics of particularly the consumer tax credit. That's the $7,500 that would be available to buyers of EVs that tick boxes with respect to where the key components come from and where the critical minerals come from in particular, which has to be free trade, US or free trade countries, and explicitly not China, Russia, Iran, Korea, right there, North Korea. So most EVs, I think virtually all EVs, don't tick those boxes at the moment. None of them would qualify for the consumer tax credit. But the OEMs were already and are now only increasingly so looking to reorient their supply chains away from those countries, regionalizing whatever material they possibly can, and securing it from free trade countries where they can't get it within the US or North America.
Okay. Well, you both kind of touched on, cost parity between the internal combustion and the EVs. And I think it's definitely a valid point. I think the thought that comes to my mind, though, in this kind of economic environment that we're in, is just what the total cost period is. And because usually we talk about adoption rate, and it's adoption rate of, with the global vehicle market, which, a few years ago, I think in 2019, it kind of topped out around, was it 100 million cars or something like that? And obviously it's been on a downswing because of COVID, because of a number of things. But I just personally, I wonder if total cost becomes a bigger issue for vehicle ownership, period, whether it's EV or internal combustion. Do you guys have any thoughts on that part of the equation? Whether, in this inflationary environment, poor economics, do you foresee the vehicle market shrinking just overall?
Yeah, I mean, it's an interesting topic, not something I spend a lot of time thinking about. I mean, shared mobility, car services where you don't have to own the car, but can simply just sort of, rent one for a short period of time and then pass it on to the next driver. That's an interesting model. And I think people use it widely in places like Vancouver, where I'm based. But I think you're talking about a fundamental shift in consumption around how people use their vehicles around the world. And I'm not particularly well placed to comment on that, but I'd be interested to hear Alex's views on it.
Yeah, I think the overall light duty vehicle market took a real hit in 2019. And then COVID meant that there was no real recovery seen in 2020. I think we're expecting to see vehicle sales increase a little bit steadily over the future, driven by some of the developing economies, but really total LTV sales getting up. I think they dropped down under 100 million and getting back up to maybe 110. Very, very, very steady growth. Like much more meaningful is the makeup of that overall set of numbers. And as Martin mentions, the potential for ride sharing or autonomous vehicles is a downside case for overall fleet numbers. I think one thing that might mess up the total cost of ownership calculations a little bit, and I'm freestyling a little bit because this isn't something I've given a huge amount of thought to, but is the increasing leasing of vehicles, right? More and more people lease their vehicle for 3 or 5 years and then they get a new one. So they never, without having full ownership of the vehicle, then maybe you're not thinking about the maintenance or the ownership cost of a vehicle over a 10 to 12 year lifespan. You're thinking much shorter term. And that may not, it may mean that people think people aren't brilliant long-term thinkers in the first place, right? There's probably a lot of people that might see gas at $7 a gallon and think I'm getting an EV, even if actually the total cost of ownership doesn't necessarily make sense because the high cost of gas doesn't move the dial enough. The people aren't rational enough actors to really think about it. But I think that sort of, I guess that's the fuzz around that's the noise around the general shift that is towards cheaper and cheaper EVs. And certainly when you start seeing lower sticker prices for EVs, that's going to make a big difference.
So we talk about higher metal prices, and I think, one of the big things that, in terms of nickel in particular, and we've seen it with a couple other metals across the, spectrum of the resource market, but when metal prices get higher, people start looking for substitutions, manufacturers, security of supply, there's a number of things that come up. Price is usually one of the big ones where manufacturers think, hey, look, we need to find a substitute for this metal. And maybe that's nickel. So my question is, in terms of nickel, how big of a threat is substitutions or alternative battery chemistries, looking out, let's say, first in the short term and then look out 5 years from now, more longer term. So, Martin, do you want to start?
Yeah, I think substitution is a key theme for nickel as it relates not just to the battery side, but fundamentally also to the stainless side too, right? You see in periods of high nickel prices, there can be a shift away from the 300 series high nickel containing stainless products to 200 and 400 series, which contain little or no nickel in most cases. So it's important that, to the extent that you might see, let's say, an EV driven, a substantial increase in the nickel price, that has implications on the stainless side. On the EV side, would maybe pass it to Alex there, but obviously we've seen the rise here in performance capabilities of LFP batteries, which are obviously have no nickel in them. My general view on that is that that's not fundamentally a threat to nickel, and it actually helps to keep nickel in a more moderate sort of level from a forecast price standpoint, and may help nickel sort of reach sort of a Goldilocks pricing where it's not too hot, not too cold. Nickel producers can make money, but the nickel price doesn't ever go too high to result in significant further substitution.
I think LFPs are absolutely the big concern in the short to medium term for nickel demand. I think, in the last couple of years, people have realized that it's not just a technology that's used for the shortest range vehicles and only will be used in China or very, very low cost markets. And instead, you see people like Tesla in particular putting LFPs in the entry-level Model 3s worldwide.
Hey, Alex, can you just define LFPs for the audience?
Sure, yeah. So LFP is a battery cathode chemistry. The LFP stands for lithium iron phosphate. This is, so within the family of lithium ion batteries, there are different metallic combinations that you can use within the cathode. And that really we're seeing the market bifurcate into two different main technologies. High nickel NMCs, or sometimes NCAs, which contain, as much as 8 times nickel to manganese and cobalt, as well as lithium. And then on the other side of that, you've got lithium iron phosphate. LFPs, less energy dense, but the technology has come on a long way. So they're competing a lot more closely with nickel-based cathodes, where there was a huge disparity in performance previously. LFP, lower cost, better, they can have better cycle life. They can, but they tend to be less recyclable because they're less valuable. Their batteries are awkward to recycle. It can be a roughly similar cost to recycle a battery, no matter what the cathode chemistry. But if you've got a higher value contained within there because of the nickel and the cobalt, then it's, recycling is more rewarding in that perspective. Also, my understanding is that I think LFPs can suffer a bit more than NMCs in low temperature conditions and high as well, but are less less successful in that way, if you like. But they have some serious advantages, and it's proving to be a technology that really is likely to occupy the lower end, sort of the entry level market. And it's interesting to see that, yes, sort of the low end trim, if you like, is your battery comes with an LFP and it will do maybe 150 miles on a charge, as opposed to you can get the extended range NMC battery cathode will do 250, 350. I think newer ones will do 400 miles per charge.
Interesting. Very interesting. Okay, so this kind of leads to, my last question, Alex, and this is directed to you. So with everything we've kind of talked about, we've had a pretty balanced discussion on, what's going on in the nickel market. What's yours or CRU's outlook for nickel in 2023?
So in 2023, like after a very slow stainless growth year, this year we're expecting to see a pretty strong rebound next year. But we really are seeing huge amounts of supply coming on stream in the form of NPI, the nickel hydroxide intermediates from the HPAL plants, and in the form of laterite matte from the conversion of NPI as well. And so we expect to see the market in a surplus in 2023 and for the subsequent years of about 100,000 tons, which is not a small amount, but then it is, we're talking about the market, is getting towards, is over 3 million tons a year now. So as a proportion of the overall market, it's not a massive surplus. And it's worth noting that I think we expect most of the surplus to be on the class 2 side of the market.
Okay.
So where that would manifest in larger discounts on class 2 compared to metal, but still a relatively tight and competitive market on the class 1 side.
Okay. Very good. Very good.
And the sort of the net result of that is we see, our price average for this year is almost $25,000 a ton. We see that moderating next year, but still staying pretty robust. I mean, for a long time, even when 2021 saw a big nickel deficit and prices responded accordingly, but really the nickel market has had very strong sort of bullishness behind it for quite a few years now, driven principally by its use in the battery sector, and it's kept nickel prices above where you might expect to see from the pure fundamentals. So even with a bit of a surplus next year, we see prices moderating, but staying around $20,000 a ton. So still pretty healthy, still a point at which nearly all operators will be making positive margins, and many projects, their economics would look decent if they're putting $20,000 a ton in their NPV models.
Very good. Okay, guys, I really appreciate the time. Excellent comments about the sector. And I think for the audience, people that are looking to understand the nickel market, I think this is a great starting point. And you can kind of trickle down into some of those topics that we covered at a high level. Martin, Alex, thank you so much for being with us today. Guys, if you have any comments or questions, please leave them in the comments below, and we'll get back to you as soon as we can. Thanks, guys.
Thanks, Brian.
Thanks for having us.